Good afternoon, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Investment Fund Analyst at SSQ. We're pleased to welcome today Jeff Marshall, Senior Vice President, Portfolio Management and Head of Credit at CI Signature, here to talk to us about the CI Signature corporate bond strategy and their market outlook. Please note that if there is enough time at the end, it'll be our pleasure to answer one or two questions that you can ask via the Q&A sections of the WebEx interface. You can also communicate with your SSQ Insurance representative for all other questions. So without further ado, Jeff, the floor is yours.
Much, Matthew, and thank you for joining us on the call. I would like to talk over the next 25 minutes about a couple of things. I'd like to reiterate the Signature model and how we think we have to approach asset management to add value in 2019 and 2029, 2039. I'm going to give you a bit of a market update, what happened in 2017, 2018 that's shaping what's happening in 2019. And then I'm going to give you some examples, which I think speak to our strategy, should give you a sense of our process and actually how we add value. And ultimately, I'd like to get to the point where you can see, you can understand this is actually how Signature adds value in the Signature Corporate Bond Fund. So, Matthew, I'm going to ask you to change the slides as we go along. But if we can if we can flip to slide 2, please. At the heart of what we do, and I can talk about strategy, I can talk about picking bonds and adjusting duration and factoring in currency, but the heart of what we do is trying to get the culture right, because we think culture trumps everything. So running an asset management firm, you better be focused on constant improvement. You better be trying to justify your fees by with a certain dedication or commitment to clients. But in terms of running the money, our view, you have to be global and you have to be specialized. The markets are too specific to try and tackle as a generalist investor. So if you're a generalist bond investor and you're trying to do EM and high yield and Canadian duration or government bond management, you're not going to succeed. The market's too specialized. And you better collaborate. So that proven cross-asset intelligence. If I learn something about the oil market, OPEC's going to keep pumping for this reason. Well, that has an impact on energy stocks, has an impact on energy high-yield bonds. It has an impact on the Canadian dollar. It actually may have an impact on what the Bank of Canada does. So it's really, we feel it is our responsibility to share that piece of information with our other colleagues across the trading floor. If I can put Signature into one sentence, which I think is very difficult, we're a global multi-asset manager with scale that we just have to be domiciled in Toronto. So we very much see ourselves competing with the large multi-asset managers all over the world. Slide 3, please, shows you some of the dedicated and specialized resources that we have across the Signature team. I like to say I'm the only high-yield bond manager or corporate bond manager that has 50 people dedicated to running my fund, and that's very much the buy-in that we require from Signature to be part of our team. Next slide, please, Matthew. So if we're running $7 billion in high yield, that's the largest high yield bond team in Canada. $7 billion in investment-grade bonds and preferred shares. $15 billion between government bonds and cash. And I'd say we have one of maybe 3 or 4 truly global bond desks in Canada, and one of maybe 1 or 2 that actually has a full EM capability for emerging market bonds. And I know that to be true because I'm actually trying to hire additional resources for my global bond capability, and I'm finding it incredibly difficult to do so. But as we think about resources and we think about scale, a lot of these asset class sleeves that we run are bigger than many of our Canadian competitors. Next slide, please. So this gets us to what I think is the fundamentally necessary equation to run assets successfully. And this is an additive formula. I actually think each factor multiplies the benefit of each other factor. So let me explain. I think you always have to start with the right culture. Do you have people buying into a specialist and collaborative model? Then multiply that by the resources that you have. So dedicated and specialized into each sector, and global. So can you look at Canadian bank stocks in isolation? I would say no. You've got to look at Canadian bank stocks relative to U.S. financials, to European financials, to get a sense of relative value. What you're learning there on the equity side can very much form your opinions of what you're doing on the bond side, the credit side, and vice versa. I think you want to multiply that effort by your scale. Scale in this business allows you to have a team of 50. It allows you to deploy resources, and it ensures your relevance with counterparties. If those counterparties are Royal Bank, Credit Suisse, JP Morgan, Goldman Sachs, you become a relevant trading partner in this business, and you get better information. Because scale and resources drives access. Access with investment banks, but also access with the companies that we're lending to, so we're buying bonds from, and that we're investing in on the equity side. We become a relevant shareholder, and we become a relevant lender. What our job is, what we try to do is turn that access into relationships. You know, can I work that relationship so that if I have a question for a company, I can call the CEO, or my analyst team can call the CFO, or if I need to talk to somebody in a different asset class at JP Morgan, is that phone call getting returned? Is there good information flow? Because ultimately, this is an information business. I'm trying to turn those relationships into information, into data, and then turn that information into conviction ideas, into the portfolio. And I think long term, that's how you have to add alpha, or that's how you can outperform in the markets. And as I think about this equation for successful investment management, for funds that you can build a practice around, it's agnostic whether it's credit or equities or foreign exchange. It's agnostic to value investing, to growth investing, momentum investing. But I think this is the model for successful investment management in any geography, in any asset class. So if we switch to slide 6, what I'd like to do is put this market context of spring 2019 in context. So I want to go back to 2017. 2016 even, the Fed in December of 2015 had just hiked interest rates for the first time in about 8 years. And even through January of 2016, Q1, Q2 of January 16, they started backing off from their hawkishness. And this is in response to market volatility. And they actually had backed off for an entire year. The next hike by Janet Yellen wasn't until December of 2016. Through 2017, investors were generally content that QE had worked and that growth, albeit low, had positive momentum. And therefore, inflation was probably going to percolate, and the deflation battle that global central banks and governments have been fighting since the global financial crisis was probably behind us. So we, at Signature, we're talking about coordinated global growth and or synchronized global growth. And really, if we look at the column in green, 2017, just about everything worked investing-wise in 2017. By the time we got into 2018, we'd gone from the prospect of fiscal stimulus, meaning tax cuts in the U.S., to we actually recognizing it in Q1 of 2018. And we're now talking about coordinated global tightening. So still positive economic growth, but now we had global central banks coordinating or more synchronized in tightening rates. So the Fed was still hiking, and they would go on to hike 4 times in 2018. And the European Central Bank was talking about when they would end their stimulus program. But really throughout the fall of 2018, economic data started to soften, especially out of China. U.S. inflation was moderating. It wasn't increasing as expected. And this is despite an unemployment rate in the United States that kept falling. And I would say, too, trade tensions, whether it's the renegotiation of NAFTA, trade tensions with China in particular, Europe, which will probably percolate later this year, was muting international investment, business confidence, and actually made it pull forward into 2017, some growth from 2018. So if we go to slide 8, please. In other words, what we think we saw in 2018 was a policy mistake from the Fed, that they'd hiked rates too quickly without the justification from inflation to hike rates. And so really what this graph tries to depict is a rolling rejection of the Fed policy, where the carry trades, and when I say carry trades, I mean yieldy asset classes like corporate bonds, real estate, infrastructure, dividend-paying equities, had to reprice in an environment where liquidity had gone lower for regulatory reasons. Investment banks just unable to warehouse and intermediate risk transfer post-2008 like they had in prior eras. And more importantly, where funding costs were going higher. Where funding costs, I mean, if you're borrowing for property, to invest in property, and your borrowing costs go higher, you can't buy as much. And that applies to the property market, it applies to the equity market, it very much applies to all asset classes. And so this was kind of one asset class after another rejecting the Fed, saying you hike too much, too quickly, these asset prices have to price lower in order to accommodate for that risk, and then there's a risk of a transmission mechanism into the real economy. So borrowing costs for corporates, so corporate bond yields going higher, high yield bonds going higher. Corporates now have to dedicate more cash flow to refinancing that debt, servicing that debt. That cash flow has to come out of other asset classes. So where in 2017 everything worked, in 2018 nothing worked. And if we think back 2 slides, in 2018 that column was all red. Nothing worked. Government bonds in the fourth quarter rallied 50 basis points, meaning yields went 50 basis points lower. That's a risk-off trade. That's investors saying the Fed's actually hiked so much, borrowing costs have gone so high, the economy is going to roll into recession. Investment-grade credit spreads widened 46 basis points. High-yield spreads widened almost 200 basis points, and we're down 4.5% in Q4 alone. Canadian stocks were down 10%, and U.S. stocks were down 13%. So fear was back in the market, fear that the Fed had been too aggressive. And if I can speak more specifically to the signature corporate bond funds, we started to see fear in the corporate bond market, specifically in companies like GE that had borrowed dramatically over decades and found themselves unable to integrate acquisitions, grow their cash flow, and basically unable to justify a single A rating. And GE got downgraded to BBB. And there was a lot of companies in the consumer staples space, like Anheuser-Busch InBev, that had made big acquisitions and paid for it with debt, and had promised the rating agencies that they could reduce debt quickly, and they weren't delivering on those promises. And so there's a lot of fear in the market that some of these big companies, like AT&T is another one, would get downgraded from high grade or investment grade into the high yield bond market. And what I'm going to tell you is that fear, if you can time it right, is actually a very, very good thing. If we can go to the next slide, please. Thank you. So when is it time to take advantage of fear? You're looking for, we look at Signature because we're integrated across different asset classes, important signals to take advantage of fear. So as I look at the credit markets, can companies still borrow? And can they still borrow reasonably cheaply? And so this is a graph of high yield bond spreads in blue, so that incremental yield, high yield issuers have to pay over treasuries to borrow. And so it went up slightly in the fourth quarter, so 200 basis points in the fourth quarter of 2018. But what I was seeing on the ground is that most companies could still very much refinance their debt. And that was an important signal for us as we looked at engaging with equities, taking our equity weights in some of the funds, taking our high yield bond up in the signature corporate bond funds to take advantage of that fear. And what do I mean by fear? I just mean that companies focused on paying down debt to protect their credit rating, to ensure their borrowing costs are low. That's the type of corporate behavior that where the benefit accrues to the lender, the bondholder. Corporate behavior like borrowing to pay special dividends or borrowing to pay to buy back stock, that benefit accrues to equity holders. And we've very much seen a reversal of that corporate behavior. So we've very much got a green light from the credit markets that there hadn't been, fear was good, but not enough fear that was actually going to impact the real economy. And if we can flip forward, please, to slide 11, trying to put that market dynamic in place. And so we've got what's happening in the financial markets, giving us an indication of what might happen in the real economy. And then I'd say politics and geopolitics has an element on that as well. And basically, hard for us to quantify the impact of this. It's something that we're thinking about. But as we think about leadership in the United States, India, Italy, Brazil, Mexico, populist administrations, and we think it's a reaction to massive quantitative easing by the Fed, the Bank of Japan, ECB, that drove asset values higher. I mean, that was the purpose of quantitative easing. But if you owned assets, you benefited from QE. The poor that didn't benefit, that didn't own assets, financial assets, didn't benefit to as an extent from quantitative easing. And so this just perpetuated and actually made worse the wealth gap and created more inequality. So we think longer term, it's creating, I would call it the politicization of the frustrated. And I think it explains trade protectionism coming out of the United States. I think it explains what I would call income redistribution from the Democratic nominees for the presidency. And I think this will be something that we're trying to quantify its impact on asset prices and financial markets for some time to come. If we go to the next slide, please, slide 12. So how do we think about the world in the spring of 2019? Well, we very much got a big gift from the Fed this January and February. When that's the Fed realizing they made a policy mistake, that they'd gone too far, and we had a Fed pivot. Basically coming out and saying, we're on hold, we're going to wait and see the impact of previous interest rate hikes on the real economy before we hike further. We're also going to slow down and stop the unwind of the Fed balance sheet. So to the extent that the Fed balance sheet is full of U.S. Treasuries and mortgage bonds, they're going to stop selling that. That's important for market liquidity. And we're also going to think about inflation. To the extent that we're targeting 2% inflation, well, we're going to target 2% average inflation. So we're actually let inflation run above our 2% average for some time. So this is all very bullish on the Fed very much being on the sidelines, maybe for a year or even 2 years. So where the market was pricing in further interest rate increases, actually now the market's pricing in an interest rate cut in 2020. And I'd say in a nutshell, I almost can't emphasize how important this is. It's a paradigm shift. It's the Fed that was focused on cyclical inflation fighting back to secular deflation fighting. So the deflation fighting that the Fed was doing from 2008 through 2015, that's back on the agenda. So the risk, probably more of a risk for Europe than the United States and Canada and the emerging markets, is what I would call the Japanification of the markets, that markets just become conditioned to low interest rates, and any increase in interest rates takes financial prices lower and volatility higher. That underlying economic growth or demographic growth is not strong enough to create inflation, but that's not our base case. So we've got a Fed on hold. We've got an ECB and a BOJ that will actually never start their hiking cycles. actually, despite economic data that we think is actually starting to look good. So better data out of China, good data out of Canada, but it probably means the Bank of Canada is on hold as well. So monetary policy normalization, that mission's now changed. Some political risks on trade, although that we see that getting resolved, and there's some election reasons why that might be resolved or be put on hold for a couple of months. Credit is healthy. Growth looks like it's stabilizing. And so re-engaged in risk assets. We think the carry trade is back, and so this is one of the large reasons why we took the high yield bond weight in Signature Corporate Bond Fund up from 48% to 55% this quarter. So next slide, please. And this slide shows you our long-term asset mix changes in Signature Corporate Bond Fund, just in response to changes in valuations, changes in environments, risk-return opportunities, taking that high-yield bond weight up once we got the all clear in 2009. And that's probably the biggest trade that we've done, taking the high-yield bond weight up from 25% to 65% over the course of a couple of years, given that valuations were very compelling and we were kind of getting that reinforced green light. The credit markets are healing. The credit markets are healing, giving us the confidence to take that high-yield bond weight, meaning the risky part of this fund, back up materially. So high-yield bond weight up to 55%. High yield's gone from a 7.9% yield to about 6.5% now. Still giving good value, fair value. IG's just under 4%. Fair value for the risk there. And we are taking some U.S. dollar risk. So we're not fully hedged on the U.S. dollar. We're hedged at about 70%. And that's a function of our view on the Canadian dollar versus the U.S. dollar. And it looks like the Bank of Canada hasn't made that dovish tack to being on hold like the Fed has. And we think it's only a matter of time before that's priced into the currency market. So in my mind, it looks like the Canadian dollar could go weaker. I want to grab some of that if I can. But most of the way I look at the hedging of the U.S. dollar is how much insurance do I want in this portfolio, where usually the U.S. dollar moves in the opposite direction of high-yield bonds. And so if I can take some of the volatility out of this portfolio by not being fully hedged, I'd like to do that. And that's something we've done over the last 15 years we've been running this fund. And it's generally, although not always, been additive to returns. So we can then switch to slide 15 very briefly. I want to talk about our process. It's unique. Managing corporate credit, so managing corporate bonds is unique because you've got all the downside of investing in stocks. Now, investment-grade bonds very rarely default. High-yield bonds default 2% a year. If the economy is in recession, it's 8-10% a year. So you've got downside risk. But if I'm lazy and I'm stupid, I can lose. I can buy a bond at par and lose everything. But unlike a stock, I can't buy a bond at par and watch it go to 200. I'm not going to see my bond prices double. So I've got an asymmetric market. I've got to be a little bit paranoid about managing that downside risk. And actually, when you're a lender, when you're lending money to companies or individuals or governments, whether you're a bank or you're the Signature Corporate Bond Fund, you're going to outperform by having fewer defaults, managing that downside risk than your competitors. So how do we think about managing money? Well, if I don't own something, it can't hurt me. No amount of coupon or no amount of extra yield can compensate for a bad business. And as I think about integrating our names with our signature view or house view on what's happening at a macroeconomic level, if it fits, great, but I always need a valuation overlay. If things are cheap, I'm willing to look through what our macroeconomic outlook might be. So a couple of examples. I'm going to skip slide 16. I'll go straight to slide 18, please. In a nutshell, our model is focusing on lower quality investment-grade bonds where we get really more compensation for doing deep due diligence on the names that we're involved in. Once we get into high yield, it's more of a focus on high-quality high yield, where I get higher returns investing in lower parts of high yield, but I also get much more volatility. So I actually like to concentrate the portfolio in higher quality high yield. A name we have here is Canada Goose, and what I like about this name is this is a name, we were shown this loan in the secondary market, so it wasn't a new issue loan, but we were shown it by a bank that already had this exposure on their books, and so we were showing that exposure or this offering because we had a strong relationship with Credit Suisse. What I like about this example is it's an unrated loan. So in this case, I'm indifferent if I'm buying the loan from Canada Goose, whereas most of the time I'm buying bonds, so floating rate versus fixed rate. Because basically, at the end of the day, I want to lend to good companies. This was the case. What makes this interesting is it's not rated. So it's not rated by S&P or by Moody's. And for that reason, it's not in a bond index. It's not in a loan index. And a lot of portfolio managers, for that reason, won't buy it. And they won't buy it because it's risky. And they won't buy it because it's risky because if it's not in an index, they are therefore automatically overweight this name. And it's like, well, I don't think of risk in terms of being overweight this name and underweight this name. I think of risk in terms of, can my clients lose money? Because that is risk. So I'm much more focused on managing market risk and credit risk and currency risk than managing career risk, which is when you start thinking about overweights and underweights. That's essentially what you're managing. So Canada Goose, I think it's a name most of you will be familiar with. Here we've got a first lien mortgage on the business, and we're earning a 6%. The next example is Enbridge. I like talking about Enbridge because it demonstrates the strength of our model, the collaboration between our equity colleagues and my fixed income colleagues. We've already owned the equity in some of the signature funds. We already own some of the bonds in the signature funds. And this was a security that's really rated on the cusp between investment grade and high yield, so BA1, BBB minus. Enbridge had made a big acquisition in 2016. So they already had a little bit of the fear in the company. And then when the broader market fear of 2018 hit, again, focused on that BBB cohort of the investment grade bond market, this hybrid security, it's hybrid because the rating agencies look at it and say, well, we're going to count it as equity, so we're not going to count it when we look at leverage, but you'll lose that treatment in 2027 when the coupon rate goes higher. So at first blush, this would be a very long duration bond, subordinated bond. In my view, it's actually an 8-year bond, and we were able to buy this bond in the mid to high 80s for about 7.5% yield, and I would do that trade all year long. It's not there anymore; it's now in the mid 90s, but it just demonstrates being able to take advantage of that fear because you have colleagues that already know a name, can get you up to speed on that name very quickly. That benefit accrues to our unit holders. Slide 20 just speaks to our ability to do private placements. So again, having the scale and the resources to dedicate to do interesting things. So again, a name like Canada Goose that's not in an index, but it offers either better covenants in this case or better pricing because we're getting paid for the credit risk and for the illiquidity risk. That's got a room that has room in signature corporate bond funds. And then just briefly on slide 21, we've been longtime holders of financial preferreds, generally of banks outside of Canada, where they're both cheaper and importantly, the structures are more complicated, meaning if you have a deep financial services team like we do, and I think we actually have the strongest signature financial services team in the country between John Hadwin on our equity side, John Shaw on my investment grade side, and Darren Aerosmith on my high yield side, you can really get your head around these securities. And this is a structure that, for regulatory reasons, it now pays about almost a 9% coupon. Now it's trading above par for a 6% yield, but that's actually a better yield that I can get in the high yield market. Or parts comparatively rated high yield would get me a yield under 5%. This is getting me a 6 because I can get my head around the structure. Again, it's another example of a security that would not be in a high yield index. In this opportunity, it's given me a better than high yield return for the risk that I'm taking. So again, it has a place in the Signature Corporate Bond Fund. And so the last slide I'd like to speak to is slide 22. Putting this all together, what are we trying to achieve? And it's trying to achieve superior risk-adjusted returns. So marrying high quality, high yield with lower quality investment grade and tactically changing that asset mix based on valuations, based on our outlook, owning some government bonds when appropriate, doing some private placements, prefs and loans for out of benchmark positioning, trying to be smart on how much US dollars we own as an insurance policy in the portfolio. So as a strategy alone, I think this strategy can probably outperform government bonds 8 years out of 10. I think with Signature value added in terms of security selection, like I said, the US dollar exposure, getting that asset mix right, very much from using other asset classes for signals, for some of that help on the security selection side, I think we're able, I mean, this is the goal, is to replicate this chart for the next 10 years, which is, can I generate a high yield type return with taking the risk or the volatility of the Canadian bond market? And I would just point out over the last 10 years, we have done that type of risk return profile, have generated a high yield bond like return, but the most high yield we've held in this fund over the last 10 years is 65%. So I'm going to stop there. I'm very much open to questions, and I thank you for your attention.
All right, thank you, Jeff. So we'll now proceed to answer some of the questions. Right now we only have one question, so while Jeff answers these questions, if you can take the time, if you want, to go to the Q&A section of your interface, and you can just ask your questions there. So first questions, what is your take on the yield curve inverting last week? It's an important signal to pay attention to, but in this case, I think it's actually giving us a false signal. Yield curve inversion, where the yield on 10-year bonds is lower than the yield on shorter dated bonds, has been a indicator of recessions 6 months to 18 or 30 months in the future in previous recessions. But it's not a reliable indicator. I think it's forecasted, if my memory serves, 10 of the last 4 recessions. So there's many times where it's given us a false signal. And I think in this low rate environment where large parts of the Japanese government bond market are negative, large parts of the European bond market, namely German bonds, are negatively yielding, or French sovereign bonds are negative. The United States, and this applies to Canada as well, is back to being a high-yielding environment. And so owning that U.S. 10-year bond where you have that insurance policy against risky assets going lower, that still has value in a global environment where those type of insurance policies are getting more and more expensive and lower yielding, or in the case of Europe and Japan, negatively yielding. So in the context of what's happening globally, in my mind it makes sense, and I'm not reading at this point too much into it in terms of very much being concerned about a recession in 2020, for example. So paying attention to it, okay, but don't think it's an indication of a near-term recession. Thank you, Jeff. So there are no more questions at this time, so this would conclude the presentation. To all of you who have listened to the webinar, thank you for your participation, and come back at the end of April as Lazard will present their global infrastructure strategy. So thank you, everybody. Have a good day. Thank you very much.